Hey everyone, this is Michael, and this is the Stock Picks video for February 13, 2022. Before I start, I just want to say that the content and information in this presentation is provided for educational and informational purposes only, and in no way should be considered investment advice. So I'll keep this video pretty brief. I just want to go over the current market environment and our current positions and our ready and watch list review, just what stocks are on there and a little color about what they're doing. So let's get right into it. Well, currently we still have a stock environment risk level at red. We're just not seeing much participation in this market. It started to look like we were broadening out, but by the end of the week we were basically just back to a few cyclical areas: oil and gas stocks, some chemical stocks, some shipping stocks, kind of breaking out, but none of them are really acting all that well. A lot of them are just reversing and closing at their lows for the day. So we just, unfortunately, the situation didn't improve, and that's unfortunately where we are. So we're still finding the current best strategy is to sell into just short moves, do shorter term swing trades. Trying to hold for bigger moves just really isn't working these days, and hasn't for quite a few months. We do have our recommended stock exposure at 0 to 20%. It's 20% is really kind of on the high side, I think, at this point. It's really just not working very well. And yeah, there's a note there. Yeah, we're just seeing a lot of breakouts failing in, and stocks are falling back in their buy zones. And there's really not a lot to like about the market right now. So we just have to be patient. Patience is the name of the game, and we really, as investors, only want to invest when it's relatively easy to make money, and we're in that environment. We're just not in that environment right now, and you just have a lot more risk of buying something and it's going down on you. And also, there's been a lot of risk coming out of earnings reports. There's been some really bad declines on stocks that have done really well up to now. So the expectations, what that's doing is telling us the expectations have been really high and now they're not being met. And that's what happens usually at the end of a lot of bull markets. The expectations got so high that companies, even if they come out with fantastic reports and up their guidance and beat by every metric, they still go down a lot because it just was too much. It was just too much, and the market really, the company really couldn't meet that demand, and the expectations were just higher than what people thought. So let's go ahead and just take a really quick look. This chart here with the red box here is showing 52-week lows versus 52-week highs. And you can see for about 3 weeks now, actually almost for a month now, the 52-week lows have been swamping the 52-week highs. Again, just another sign that it's very weak under the surface, and we're just not getting a lot of rallies that are moving higher on a consistent basis. And then finally, I've showed this chart before. We have only 20% of Nasdaq stocks above their above their 200-day moving average. If you reverse that, it's really 80% of Nasdaq stocks are below their 200-day moving averages. That's a bear market in progress, and it's already been here for a while. And this has been trending. This line here has been trending lower for almost a year now. So all in all, it's not a strong market, but we're still looking for the best performers in this weak market. And when the market turns around, some of these ones that are holding up the best will turn out to be the next crop of market leaders. So I'm going to pause the video for a second, and I'll come back with the charts. Okay, so let's go ahead and start with the stocks in our ready list. Really only 2 candidates now. It's been kind of floating. Sometimes we've had 5 or 6. We're down to 2. Either the stocks are moving out of the range, or they're just breaking down. So not a lot to choose from. This is just one of the few ones in the shipping area, which has been doing well. And then oil and gas have been kind of some of the strongest areas. It's been a really choppy period here, even though we've been kind of just heading higher. We've been kind of floating in and out of this blue buy zone. The volatility here is not great, so we haven't bought it for our portfolio, but it's something that we've been watching. We were hoping it was going to kind of tighten up and give us a better entry with not as much overhead supply keeping it down. Because it seems like whenever the market's the stock's getting up here, the sellers are appearing. But it looks like it's improving. It's almost out of the buy zone as of Friday. So we will keep that on the list. And we do like the fact that the relative strength is rising nicely. And we've had some decent volume, at least on Friday. So it's looking pretty good. The volatility has just been a little high, so we haven't actually bought it for our portfolio. Plus, we have a couple other positions that aren't doing. Actually, we have 3 positions right now. They're not performing all that well, and we don't want to add any more exposure. That's a question I sometimes get from people, is like, how come you have other stocks on the ready list but you don't buy them? It has sometimes to do with just how much exposure we want at a certain time. Sometimes we'd have them all if we have the funds, and other times we just don't want to have any more than a small exposure because they're just not working very well. All right, let's look at this. The other one is Stifle Financial, ticker SF. Again, this is typical. This was showing a lot of strength. You can see, just like the last one, we we're trying to get near this old high. We broke down and then we came ripping straight back up. A lot of stocks have been doing this. And then we did break out on nice volume here too. And then we've just had 3 days in a row, lower low, lower low, lower low. That's a warning sign that this is not acting correctly, and 3 days of higher than normal volume. Another warning sign there too. So this one we'll watch, but this is not how we would like to see it acting. Ideally, this decline would have come on lower than average volume, below this 50 period line over here. But we'll see. It could just come down maybe a little bit more and then try to bounce straight back up. If it does, and market's improving, we might try to buy it. Otherwise, for others, you could buy this on a pullback that kind of reverses back up. Earnings are pretty good. Sales have been pretty strong across it, and the margins are strong. So all in all, it's a leader. It's one of the few stocks that's been really acting pretty well. It does have the RS blue dot, which we like to see. But in the weekly chart, it gives you a little different perspective. We did have a big reversal and we closed down near its lows. Not a fantastic sign, but my guess is that this stock wants to go higher, but the whole general market is holding it down. But these are the ones we like to see that can hang up near their all-time highs and try to break out when the market's doing poorly. And then when the market turns around, then these are some of the first ones that just take off. So we always want to watch these and look for them. So let's go ahead to the watch list. We've only got 4 stocks on it. And the first one is actually one of them that we did buy. It's in our portfolio, Intrepid Potash. And these chemical stocks have been one of the few areas, along with oil and gas and some shipping, have been holding up. But Friday's action was really not as good. We did a complete reversal from a breakout, very high volume, closed in the lower third of its range. Not a great sign. This is one that we, we're in it. Our stop, I'd have to see where our stop is. 1 second. 44.18. So if I look right here, yeah, our stop is, it's actually right around the 21 days. We might get hit and get kicked out. That stop was about 7%, so we don't want to go any more than that. I think we're right below this day's low, 44.20. Yeah, we're at 44.18. So our stop was just below the low of this day. It really shouldn't break it, but it's not acting well. So we may be losing this one, but we'll stay with it. We're down 3.6% right now. We have a little bit more to go, so we'll see what it does. But that's typical of this market. 1 minute looks good, and then you have these big sell-offs that make the picture a little less bullish. So the next one is Ryan Specialty Group. They provide products and solutions for insurance brokers. And this one we've been watching. It's a recent IPO, but it's actually acting quite well, which in other videos I've talked about how I've looked about all the IPOs over the last year. I think there was about over 500 of them, and about 480 of them were going straight down. I mean, the charts were just absolutely terrible. So this is one that we're watching because the RS line is actually making new highs, and you can see the S&P is this line is struggling. This is actually heading up, so it's outperforming the whole market by quite a lot, and it's getting near its old highs. So this is one, it's not set up yet, but we're going to keep watching it, and that might be one that we really could get a position in. Next one is Capri Holdings. So this was I talked about last week too. Unusually, it's a women's and men's accessories, footwear, and apparel company. We haven't seen these kind of companies in a long time. They're all been cyclicals. So the fact that this is poking its head out into new highs is a great sign. Strong RS. Again, like the other ones, it's tried to break out on good volume, but it can't hold it. There seems to be, you can see from the chart, there's just a bunch of, when it gets around 68.5, 69, excuse me, we're getting, sellers are appearing and taking some profits or are getting out if they're the ones that, got bought over here and got trapped. And now they're happy to get their money out. So that's one we're going to just continue to watch. It's looking pretty good, but it's not quite there yet. And then the last one is CenterPoint Energy. This one's actually a utility, but it's been acting really strong. And sometimes these utilities can make really strong moves, which is surprising. Sometimes you think, well, they're just boring and dull stocks, but they can actually make some nice moves. We do like it sometimes to have some lesser volatility. Again, it was looking nice and tight here, and then it broke down below the 50. So we're watching it. Now, if this goes much farther down, it'll be off our list. And our long-term outperformers, we haven't had any of these for a long time. The market just, most of the names that were stalwarts in that list were just, fell apart. Apple had a bad day on Friday. Volume wasn't too bad. You can see down here. If it has much more of a decline, we'll have to take this off the list. It's not acting very well. We were hoping that this was going to kind of tighten up over here and then break out of this little consolidation, especially over this level, but it seems to be doing the opposite. So let's take a look at our portfolio stocks. We already looked at Intrepid Potash. We do have Robert Half, which has been also showing some nice strength. Again, it tried to break out, and we're just pulling right back to the top of the base. It's really not doing anything wrong. Volume has been lower, unlike some of the other ones we saw that have higher volume. So it's looking okay. We'll just have to hang on to this. Obviously, we'd like to see it just take off, but it did run up, pretty significantly. 1, 2, 3, 4, 5, 6, 7 out of 8 days. And we were buying it up here, which we don't really like to do. I think we bought it breaking out of this little 2-day area here. We much rather would like to buy, like when you look over here on this chart, this part of the chart, where it's been kind of forming a base, got really tight over here, and then it broke out, out of this whole area. So we're not buying it after a big run. So this is actually normal, but we'll watch it carefully in case it decides to not treat us well. And then finally, we have Nutrien, another chemical agricultural stock. This one we bought coming out of this little consolidation. It's actually pretty well. We have 1, 2, 3, 4, 5, 6 days up in a row. We are kind of struggling to get past this old high here of 77.35. It's really not doing anything wrong. Volume's been nice, strong. The only thing we have to be concerned about is we have earnings in 3 days. And currently we have a 3% gain. And we'll see if we may hold into earnings if we can get maybe a little bit more. I'll also do you can actually check about looking at the options about, you can kind of calculate what is expected to be the volatility of a stock, and you can kind of see if it's within range. Sometimes it'll be like maybe is a 3% volatility expected on earnings, so you're able to hang on to this. because you already have a 3% gain. Worst case, you'd lose it. Sometimes it may be 10, 12, 15% for volatile stocks. Obviously, you need a much bigger gain to hang on to it without risking, your capital. So we'll watch this one for the next 3 days. What's been happening lately is we're getting a lot of stocks that are rallying into their earnings. So we might end up with a 5, 6, or 7% gain going in, which in case we'll probably go into it, or even maybe take a little bit of profit just to protect our profits. So, well, that's about it for this week. We'll be back next weekend with the same for whatever our stocks and watch and ready lists are at that time. Okay, thanks. Bye-bye.